Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 16th of June 2023, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Quant Research Analyst at MUFG. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi Lee.
Hi Abdul-Ahad.
Let's kick off. It has been a busy week for central bank policy updates. What have been the main implications for the FX market?
Yeah, it certainly has been an interesting week for FX markets, where we've seen certainly more volatility over the last couple of days when we've had the central bank updates. To us, there have been probably two main implications for FX markets. So one is the weakening trend in the yen has continued. To us, this makes sense fundamentally. This week, obviously, in terms of the central bank updates, the BOJ again stands out as the most dovish, with them maintaining their loose policy settings. Whereas if we look at the policy updates from both the Fed and the ECB, they've both delivered hawkish policy surprises this week. Fed sort of kicked us off where they signaled that they're planning two more rate hikes, which was certainly more than ourselves and the market were expecting. And then the ECB followed that up themselves by hiking rates by a further 25 basis points and indicating that they plan to hike rates again as soon as July and maybe even for a further time in September. So that has put upward pressure on yields outside of Japan, and that's putting further downward pressure on the yen, encouraging market participants to put on more yen-funded carry trades. And that's supported as well by the broader environment in financial markets. So we're seeing volatility across most financial markets, whether that's FX rates or equity markets. Volatility has been dropping back. And at the same time, investors are becoming more confident and to put on risk trades. So all of those factors point towards sort of yen-funded carry trades becoming more attractive, and that's putting downward pressure on the yen. And then the second, I guess, takeaway from this week is that we have seen the euro-dollar rate climb back up towards the high for this year. For most of this year, it's traded within a 105 to 110 range, and now we're back closer to the 110 level. To us, this has been driven by a couple of factors. One, like we were saying, the ECB certainly delivered the hawkish surprise yesterday, certainly indicating they're more concerned about upside inflation risks, particularly to core inflation, and that they need to do more to get those risks under control. And then outside of Europe as well, we've seen some policy developments in China this week, which we think are important for the FX market and the dollar more broadly. We saw the PBOC start to cut rates. And we've also heard that Premier Li over in China is proposing a stimulus package as well to try and provide more support for the recovery there. So this gives us more confidence that growth in China can pick up in the second half of this year, and that's encouraging market participants to pare back some of their kind of recent pessimism over the outlook for China's economy. And to us, that's obviously a positive story for China's growth going forward. And on the other hand, it will also help to weaken the dollar.
Interesting stuff. So the pound has continued to outperform this week. What are the main challenges in the week ahead?
Yeah, like you say, the pound is certainly one of the kind of big success stories this year in the FX market. We've seen the pound this week climb to fresh highs against the dollar, the euro, and the yen, so against all the major currencies. And to us, it's still kind of a continuation of the kind of same fundamental drivers that have been in place over the last couple of months. One being that the UK economy is proving more resilient than expected. And at the same time, the UK rate market is being forced, or certainly encouraged, to price in a more aggressive and extended rate hike cycle for the Bank of England. Obviously, the latest kind of trigger for the latest move higher in UK yields this week was the release of the much stronger labour market report, which showed very strong wage growth in the UK. So to us, it certainly makes sense that the UK rate market is becoming more nervous, that the UK may have a bigger, kind of more persistent inflation problem on its hands than the Eurozone or the US economies. So we have certainly seen that kind of policy divergence starting to be priced in quite significantly into the UK rate market, and that has meant that yield spreads between the UK and the US and Europe have moved sharply in favour of the pound recently. So to us, it certainly supports this period of pound outperformance that we've seen. Whether that continues in the week ahead, we would still say that the underlying trend is higher for the pound from here, but there are obviously risks in the week ahead for the pound. One being the release of the latest UK CPI report for May, and then that will be followed as well by the Bank of England's policy meeting next week. Obviously, like we've been saying, the UK rate market has moved a very long way now to price in much higher rates. The terminal policy rates has risen up to about 5.75% now. So that's about 125 basis points of further hikes from the Bank of England. And to us, we do expect the Bank of England to be hawkish next week and to hike rates by 25 basis points again. But it will be hard to surpass those kind of hawkish expectations that are already priced into the market. And that, on balance, we think the risk may be that there could be some disappointment if the Bank of England isn't as hawkish as the market is currently priced for. I think really for the Bank of England to kind of exceed those expectations, or to at least meet expectations for those aggressive hikes from here, it either needs to hike rates by 50 basis points next week, or at least signal that that's coming back under consideration for their next meeting in August. So we would, on balance, be certainly cautious about continuing to chase the pound higher in the week ahead, given those risks. And then finally as well, thank you, Abdul-Ahad, for joining today's podcast. I know you have been creating some of your own short-term valuation models for the major FX rates, and it'd be interesting to hear your thoughts on recent moves in the FX majors and whether you think those have been in line with short-term fundamental drivers.
Yeah, definitely. So our short-term valuation models support our expectation for euro dollar to continue to trade at higher levels, closer to 110. The improvement in global investor risk sentiment is helping to weaken the dollar, while the US rate market remains reluctant to price in more than one further Fed hike. At the same time, our short-term valuation models are signaling that yen weakness is currently overshooting relative to fundamental drivers and casts doubt on how long dollar yen can be sustained above the 140 level.
Great, thank you. Great insight.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.